We've got Adrian Mowat, emerging market equity strategist, joining in on the show. Also have James Knightley joining in, economist at ING. Gentlemen, hi, both of you. Morning, firstly. Adrian, if I could come to you, I think the messaging from FOMC seems pretty strong and clear. Stronger inflation won't stop rate cuts. What's been your reading? Because it seems like there's 3 to go this year itself.
Yes, but remember the 3 to go is quite a bit less than the market was expecting at the beginning of the year. So the story seems to be one in which the US economy continues to surprise on the upside in terms of economic data and momentum. You know, the moderation, the sort of second differential that we had in our favor with declining inflation doesn't seem to be there in the first quarter of this year, and maybe not the first half. And it is important to look at the dot plots from the Fed, which are drifting higher in terms of their projections for this year, next year, and into 26. So, you know, the narrative seems to be that the Fed was quite dovish, but there was hardly any move in the 10-year bond yield. And I think the move in equity markets, if the Fed really was much more dovish than people were expecting, would have been more dramatic than we saw overnight.
Morning, let's get in your take as well. Do you think that perhaps the fact that no news is good news is what really played out this time around with the Fed stance?
I think, you know, looking at it, it was generally, I think the market interpretation, yes, it is initially dovish. We got the confirmation of the 3 rate cuts staying there, but you know, we did see the longer term interest rate views raised, and that's I think is very important as well. I think there is clearly an inclination from the Fed to try and move policy back to a more neutral footing. After all, they don't want to cause a recession if they can avoid it, but nonetheless, that increase in the inflation view, and of course they're still expecting 2% plus growth for the next 3 years as well, and low unemployment. It just means that I think we still have to be braced for the idea that there is still a degree of hawkishness within the committee, and it's actually going to take quite a bit of weakness in the activity side of things, as well as inflation moderating, to indeed deliver more rate cuts than they're expecting. So I think there still is the risk that risk assets have gone a little bit too far too soon. And you know, we've got inflation data next Friday, and the risk is that that does again come in on the upside. So this positive reaction we've had today, you know, it may not last all that long.
Adrian, you made a very interesting point as to how the markets didn't quite have an exaggerated reaction if they were really reading a whole lot into the dovish commentary. What, according to you, is then the likelihood of these 3 rate cuts coming in for sure? Because, I mean, what if inflation doesn't cool down as per Fed's anticipation?
I mean, my bias would be that the risk is fewer than 3 rate hikes, just in terms of looking at the economic momentum that we have in the US, plus the fact that we're still well above the central bank's target of 2% inflation. You know, I sort of concur with what James was saying. And to me, the biggest risk is coming from the bond market. So on Saturday, the 23rd of March, if the yield curve is still inverted, and it's 110 basis points inverted at the moment, that'll be the longest period of yield curve inversion since the Great Depression. Now, yield curves are inverted when you're expecting a recession, but we've just had the Central Bank of the United States coming out saying they're not forecasting a recession. There is an issue here. Bonds are massively overvalued versus cash at this point in time. And you resolve that either by bond yields going up or by short-term cash yields coming down quickly. And there is nothing in the FOMC minutes or their summary of economic projections that would suggest that short rates are going to come down quickly. And that means that the risk remains to capital markets as you get a sell-off in bonds, similar to what we saw in September and October 23.
You concur with that with respect to the risk continuing to remain, especially in light of the fact that the inflationary data remains on the higher side?
For me, I think in the near term, the risk is that we do see yields end up pushing a little bit higher. I think we've seen, I think, clearly the market wants to rally on any bit of news that sort of backs up this assessment of a soft landing and, easier Fed policy. I just think that there is the risk that we do still see the data remaining a little bit too firm, and we do see in the near term Fed officials, perhaps becoming a little bit more reluctant to back an aggressive early swift rate cut profile. That said, medium term, I am more negative on the US economy. And there are a number of reasons for that. Firstly, we really do have to focus on the consumer. Consumer spending is 70% of the US economy, and real household disposable incomes have basically flatlined for a year and a half. And I see very little prospect of those accelerating meaningfully because the labour market is cooling and employment cost, the best measure of labour market inflationary pressures is the employment cost index. And I think that's going to be moderating very, very rapidly indeed. So I'm not hopeful that real household disposable incomes are going to be a big growth driver. Pandemic era savings have largely been exhausted as well, according to the San Francisco Fed themselves. And of course, we've got credit card borrowing costs at the highest since 1972, car loan borrowing costs at the highest for 25 years, and personal loan rates at the highest for 20 years. And that too is going to be acting as a brake. And note too that rising credit card delinquencies going from 4% to above 8.5% are also indicative of financial stress. So I think near term, there is the risk that, we do see more, more pushback a little bit from the Fed. But I do think second half of this year, we could see more aggressive rate cuts coming through than the market is currently anticipating.
Interesting. So, Adrian, what's the prognosis then for equity markets? Because yesterday we settled at a new record close. I know you anticipated a more exaggerated reaction if indeed the markets were reading a whole lot into Fed's dovish commentary or thought it was dovish enough. But do you think this is a market which is running on its own steam?
Yeah, I mean, at the moment you have strong economic data. Companies reporting numbers that are above expectation, plenty of momentum in equity markets. And I see the only obvious thing that could derail that is the bond market having a sell-off, which I was commenting on earlier on. So for now, I suspect the trend is equities move higher. I think there's an interesting trend developing in Asia, that there's massive pessimism around China. The macroeconomic data in China has turned out to be better than admittedly pessimistic views. And at the company level, you're seeing results exceeding expectations and companies announcing quite significant share buybacks and increases in dividends. And so I think there's a story of a broadening equity market. We've seen some good moves in global financials, both in the United States and in Europe. So it's moving away from just being driven by a narrow number of tech stocks. So bull market continues unless we get a sell-off in bonds. And it's a story of a broadening. It's a broadening within sectors in the United States. And I think it's a broadening to Europe. It's a broadening to possibly emerging markets beyond India, which has been very strong. And that's going to be the story for the sort of second and third quarter of 2024.
Okay, thank you. Thank you so much, Adrian, as well as James, for joining in with us this morning and giving us an understanding in terms of the global setup, in terms of what one should be expecting going forward as well.
If you like this video, then like, share and subscribe to ET Now.